This episode of the Old Dogs REI Network is brought to you by Mino Studio.
In a world where jobs are how most people make money, one man, one desire, one challenge dares to break the mold. Welcome to the Old Dogs REI Network, where we don't work for money. Money works for us. Coming soon. Viewer discretion advised.
Welcome to the Old Dogs REI Network, where cash flow is king. Real estate investing, the means, so you can enjoy your retirement dreams. This is the show where we cut right to the chase. No sales pitch, no long monologues, just simple how-to real estate investing advice, so you can earn the passive income you need to enjoy your retirement today. And now, your host and chief old dog, Bill Manacero.
Welcome to the Old Dogs REI Network. I'm your host, Bill Manacero, and this is a show where 50-plussers and anyone else who wants to join us get solid, no sales pitch real estate investing advice to help generate real cash flow. This podcast airs twice weekly on Mondays and Fridays, and if you aren't already a subscriber, go to iTunes or Apple Podcast, type in Old Dogs, spelled D-A-W-G-S, find our podcast and subscribe. We've got a great show for you today. A gentleman who has a great deal of experience in all kinds of commercial real estate, primarily on the debt side of things, financing, as well as he is an active investor as well. And I'm talking about David Blatt. He's the CEO of Stack Partners, an advisor focused on helping real estate clients find debt solutions, including project financing, loan sales and syndications, and loan workouts and restructuring. David is the host of a real estate investment podcast, Make the Deal, Real Estate Investing with David Blatt, a frequent public speaker on entrepreneurship, innovation, and capital and investment trends in real estate, and has spoken at top real estate conferences. He is a registered investment advisor, is licensed to practice law in New York, New Jersey, and California, and is a real estate broker in both New York and Florida. Well, David, welcome to the Old Dogs REI Network.
Thank you for having me.
Oh, it's our pleasure. I'm stoked to have you on. I've heard you on other shows, and you've got an amazing background and story to share. And I'd love if you just gave us a little more background about yourself, and then how you kind of moved into this real estate world here.
Yeah, I've been in real estate for the last 20 years. I came out of graduate school and was always entrepreneurial, looking for a way to essentially set up my own investment platform. It was something I knew I wanted to do. I didn't necessarily want to go work for some big brand institution. Just wanted to work for myself. And I always gravitated to real estate. I just liked the idea of buying an asset that is appreciating in value over time and also throwing off cash flow. So when I started in the business, I really didn't have any contacts. I just started to interview around in terms of just networking, and I found a really small investment shop that I liked. They were doing a lot of environmentally distressed property acquisitions and redevelopment, and they were looking to hire a receptionist. So I came in and I told the principal of the firm that it was his lucky day.
Now you're a licensed attorney, you're a real estate broker and a professional advisor here. Okay, and you're applying for a receptionist job, right?
That's exactly it.
Oh, God.
Yeah, I didn't have a lot of people in my family that were thrilled with that idea. Uh, But that's exactly what happened. So I came in, I said it was your lucky day. You're going to hire the most overqualified receptionist. And I said, you don't even have to pay me anything extra. I want you to pay me what you would have paid someone that you hired for the position. But in exchange, I want to get three things. I want the experience in the industry and learning what you do. I want to build my network of both real estate professional contacts and investor contacts. And I want the opportunity to earn equity in the deals that we do together where possible. And then my caveat at the very end of this pitch was, once I feel that I've learned enough, I'm going to leave you. So
I love it. That is so amazing. Wow.
I wanted to manage the expectations on the upfront. I was offering a good deal, but it was a limited time offer. So that was basically the pitch.
And how long did you actually stay there?
I was there for 2 years, and then I felt like I was ready, and I left, and I started my own real estate investment platform, and just started to find deals. I started to raise money from investors and was able to scale pretty quickly. And then that morphed into a full-fledged distressed debt fund. So I had learned the distressed business from this company where I worked for a little bit, and they were focused, as I mentioned, on environmentally distressed assets. But I learned the distressed debt business, just broadly speaking, where I could go and buy defaulted loans from the banks or REO from the banks if they had taken the property back through foreclosure. And I really liked the business because, I think everybody likes at least the aura of the business where, you feel like you're getting a good deal. But there's obviously something that has impacted the asset. You got to go in, you can actually create value and really turn something around to just make a really good return, whether you're selling it or if you're holding on to it. So that was really where I started to focus. And, I also felt that the market was just, I was very early to the sky is falling, just like pitch in terms of, having started my fund. This is going back, a few years before the last recession. And then when the recession hit, all of a sudden everyone was like, wow, you knew. I was like that crazy guy on the corner for 5 years saying the world was going to end. Yeah. And then it finally did. So, suddenly I was dead on. But, it was great because I had built up enough of an infrastructure and a track record and had institutional capital dedicated to what I was doing, and through the last recession was able to really focus on buying a lot of distressed opportunities, and really had a fantastic run until the market started to recover, and then those opportunities really dried up in terms of the just mass of them that were available at the time.
Sure. What were some of those early deals that you landed when you first started your company?
In the beginning, like right when I left, maybe a few months in, I just bought an apartment building in New York City. It was a small deal. It was I remember like a 9-unit deal. I think all in, it was like $1 million something. I was able to raise equity, get a loan, and close it. And then shortly after, I learned of a deal that was like a 20 building portfolio for $15 million, and so I was able to scale pretty quickly. And that was like an off-market deal, and in the true sense, where no brokers were involved. I found the seller direct, and they had a buyer that fell out of bed, so we were able to take that down. And then, as I mentioned, I started to reconnect with a lot of the banks that I'd been dealing with at my job, and really just started to cultivate that network to see what kind of deals they had on the books that they didn't like. I just really liked the dynamic of that transaction, simply because, if you think of it in the classic economic terms, where you have a buyer who wants the lowest price, the seller that wants the highest price, and that point where the deal gets made is that intersecting line, the equilibrium point, So in the distress space, when you're dealing with banks, you have the buyer that wants the lowest price and the seller that really wants to get this off their books. So it's a different motivation, which really then favors the buyer who wants the lower price, if you can deliver certainty of execution. So that was really where I started to focus and really scale up. And, that's it just kind of grew from there. And, we were managing a few $100 million, like at its peak, so it really grew from, like I said, the one small building into something far greater.
That's awesome. Were you primarily in multifamily, or was it just across asset classes?
It was across asset classes. It tended to be multifamily. I just think that was a function of what was presented, but I got involved in every asset class at that time. Industrial, office, hotels, gas stations, marinas. Really funky stuff.
Wow.
It was in the end, the analysis. The beauty of real estate is that the analysis is really simple. You have a lot of sophisticated shops and a lot of, really, savvy institutions, that maybe are looking at things in a way that, feel like it's, above the best, an individual's pay grade. But at the end of the day, this asset class is so simple. It's really about, what did you buy in for? Can you sell it for more if you needed to? Is it going to value out when you finance it? And will it cash flow enough to cover your expenses and give you a return? Right? That's it.
Right. Wow, that had to be very exciting times. Did you have a good feel for how long the recession was going to continue? I would think you would have had to buy into certain types of deals.
I thought it was going to last a lot longer than it did. If the market had processed everything that had happened to it on its own, without government intervention, without question, it would have taken a really long time for the recovery to materialize. And it was really a fascinating time for me, because it really taught me that you can analyze a deal on its merits from the perspective of value and what your motivations are to put your money into a deal. But the one thing that you can't predict or underwrite or project is regulation. And it was such a good lesson for me at the time, on a go forward, to, I guess, learn one. We talked at the time about the concept of too big to fail, but, being attentive to where the government is thinking about things is hugely important. When you're making investments, and to the other side of that coin, and I'll point to New York as a good example of that. But a lot of buildings in New York have rent regulation around them, and for the longest time, there were ways that you could deregulate units, and so it's been a pretty steady business to buy things at what would be top dollar on in-place value, with this business plan and expectation that you can get the value up by deregulating these units. And now, as of, call it, a year or so ago, that's no longer on the table. So you've had a whole bunch of investors that for the last number of years have gone in and paid based on this kind of a business plan. So they basically made a regulatory bet that it was going to remain as they expected it to. And then just like that, it turned against them. That has nothing to do with, did you buy a good deal? Are there drivers here supporting growth? Whether it be rent growth or, just population growth or income growth, none of that, right? I mean, you're betting on regulation. So as a result of my experience, I would never do that, because you just don't know. Things can turn.
Yeah. Well, speaking of which, I mean, I'm looking at, what you did during the Great Recession here, but yet we're sort of on the precipice of something else that may or may not happen. And I know there's a lot of factors that go into this. How are you looking at our current economic situation? I mean, there's a lot of factors that come into play, but I mean, you're in the heart of New York City, that's definitely got hit very, very hard here. And what do you see ahead? And do you see a sort of a repeat of things that you saw back in the beginning and coming out of the tail of the Great Recession?
So I work nationally, and my investments have really been focused over the last number of years in the Southeast and Southwest, primarily, just because there's been a lot of what I would describe as like macro growth drivers that I like behind that. But to really touch on, what do I see ahead? So first of all, I think that the one thing that we got right was, the government just jumped into action to support the capital markets, and real estate isn't everyone is very focused on the interest rates. In terms of what's my financing going to cost when I make investments. But if you look historically at the impact of interest rates on real estate values and the pace of the market growth and things like that, it doesn't necessarily correlate. What really correlates more closely is capital availability, right? How much capital is in the market? And in this go around, the answer is we've got capital. We've got debt capital. We've got equity capital. And people like real estate. The other thing is where, the last recession was problematic. It really highlighted how real estate is this big, slow, fixed asset that when you want to get out of it, you really can't as quickly and easily as you thought. And values are going to move far faster than you can liquidate if that's what you're looking to do. This time around, I actually think that's been working to investors' advantage because, the steady buy and hold right now is just a good place to be. And the asset really forces that discipline. So it's another reason why I actually do like real estate, broadly speaking. In terms of opportunities, it's obviously uneven, right? You look at things like retail and it's just getting obliterated, but that story has been going on for quite some time. Malls have been struggling for quite some time. They could have done without this, but they've been basically moving towards a different format and trying to figure out ways to essentially morph into something different than they've been because of the struggle and because of what e-commerce has been doing to them. Hotels are obviously getting seriously impacted, but if you have patient capital and a strong stomach, I actually think there's some amazing opportunities in the hotel space, because you look at where places have reopened, and I know there's been spikes in certain markets and things like that, but there's this pent up sense of people wanting to travel and people wanting to get away when they can. So at some point when things normalize, however that's defined, I do believe hotels are going to benefit from that tremendously. And I think particularly, when they've been under attack, let's say by like the Airbnb model and things like that, there's something comforting to know that there's a big name corporation behind cleaning protocols, where, Hilton says, this is how we take care of our properties, and you can take comfort in that. So I think that actually helps their story. So that's how I feel about that. But I think actually in the next, what I would say, like by year end, beginning of next year, I think if you're an opportunistic investor, I think you are going to be presented with some really interesting opportunities, because we went into a timeout as a result of lockdown, and a lot of banks put forbearances across the board on the loans that they are carrying. And now that those things are burning off, there's going to be a clear idea of, all right, who's going to make it back and who's just not coming out of this alive. And those that aren't going to come out of this alive are just going to be, written off and sold off. So I think there's going to be some really interesting opportunities for opportunistic buyers. And then the last point I wanted to make, even though I know you don't want a whole download of sector by sector here, but I think right now, you can't ignore the attention that the suburbs are getting as a result of people wanting more space, people needing that home office, people not necessarily having to come into the office on a regular basis. And so I do think that, certainly home ownership, the single family rental asset, and even suburban office, which hasn't been a popular asset class for some time, I think are going to be fantastic opportunities.
That's interesting. Yeah. You've already seen currently this boom in suburban real estate just taking off. And I think it's like you said, there are those companies that are realizing that they can operate remotely. And so people are saying, hey, why do I have to deal with this horrible commute? I can live in the burbs and do the same thing. I think homes with offices are going to be especially attractive to people. Because a lot of people will be working out of their homes. So, but I also think, like you said, the suburban office space, it's kind of interesting. It as an area that might really take off too. That's a really good point. What do you see for multifamily? I think one of the things that, like you said, the forbearances, everybody offered them, and they're pretty much coming near the end of their run. And then same with the eviction moratoriums. Okay, those are starting to pop off one by one here, so I think there's a lot of things that are just, it's almost like a suppressed impact that may, like you say, hit at near the end of the year. We'll really start to see it. Where do you see in terms of the multifamily asset class in all of this? Do you see that being a little stronger, a little more resilient than others, or not?
I do think it's more resilient. And there's just, there hasn't really been a drop off in demand for multifamily investment assets. and going back to this idea of non CBD downtown type multifamily, the more garden style complex in particular, I think that's going to continue to just draw a lot of investor attention. I recently saw a trade that took place in Tennessee where it was being marketed as call it the Nashville MSA, but it was way out. It was generously, call it within the Nashville radius. You could get there from Nashville, but nonetheless, it was marketed as Nashville. A buyer paid top dollar for it. But what was fascinating was that there were, I think, something like 25 bids for this property, and it was your Class B value add kind of multifamily, in a pretty far out there market, and I think that that's just really indicative of the kind of demand that's there. So certainly there's investor appetite that was there before. There continues to be. I think the fact that, there was no hiccup in financing for the asset class is hugely helpful. I think you want to think about I know moratoriums are burning off, but, people get accustomed to the tools that they use. And so, you want to think about where you're situating. Obviously, you want to look at what's driving growth in a given market. But, again, you want to also think about that regulatory factor going on because, what they never solved with a lot of this stuff was when they passed the responsibility up the chain to the owners and the investors, the carrying costs, never got a timeout necessarily, so I would say either make sure you're going in with appropriate reserves, or just strongly consider where it is you want to invest your money.
The lending environment, how is that right now? I know it definitely initially it tightened up in a lot of realms, but where is it today on your end?
I speak to a lot of lenders and a lot of lender profiles. So everything from your small private lending shop all the way up to your traditional banks into your Fannie and Freddie type lenders and big institutions. So what I would say is this: everybody's open for business, and if you ask them, everybody's open for business. The only thing is they're definitely being super picky about the deals that they're financing. And this has nothing to necessarily do with the merits of a deal that might get presented for financing, and more to do with who is presenting that deal. So, it's definitely a bit challenging for somebody who may not have a track record to get financing on a deal that completely pencils as much as somebody else who may have done it before. And what I have noticed is that the levels of financing have dropped. And I think in the beginning they dropped because lenders had no visibility into the future because we've been in uncharted territories. But I think a lot of it also just has to do at this stage with lenders to some degree being more opportunistic in the fact that it's, they look at it, right, from a lender standpoint, the interest rate they charge is, this is how much my money costs. So if I can charge you the same, but give you less of it, that's a much better deal for me. So, we're seeing a lot of that as well. But, for all intents and purposes, if you have a deal that makes sense and you have the right asset class, then I would say you should have no problem getting financing right now. So certainly multifamily is a very desirable asset class. Industrial, hugely desirable asset class. Single family rentals, same thing. Self-storage, also, like, these are the kinds of things that, are just no-brainer financings.
What are sort of your primary target deals? I mean, who are you appealing to, and what can you offer them?
I have seen an uptick in distress opportunities. There's been a lot of situations where buyers that were at the table pre-lockdown have fallen out of bed, and now the deals have come back our way. So we've been we're working on a couple of deals right now that are REOs from the banks. We're actually buying some that are and they're suburban office assets because I don't just come on podcasts and tell you where I think the market's going to go. I actually drink my own Kool-Aid. So I do believe in the suburban office asset class right now. And I think, buying those in the right markets are just really good long-term holds. And I think there's growth there. I am also working on some distressed notes, backed by single-family rental. I think that, distressed is not necessarily an indicator of where the market is as much as the circumstances around a given deal. And so, I say that because I think single family rental is just so strong right now as an asset class because of people, just putting such a value on space, and there not being enough homes for sale, or people simply can't afford them. But, with that said, if you can get your hands on a situation that is impacted, then all the better. So, we're working on that avenue as well. So, and then for us, we're really just thinking, I like to think about, markets in which to play. And so I like looking at growth markets. As I mentioned, we've been active in the Southeast. I really like the Carolinas. We're also active down in South Florida. So places like those, are great. And even markets in the Southwest, and I can go on. But I really, I try to distinguish this when I talk to investors, and just people in the real estate space overall. There's truly a distinction between speculating and investing, right? And if you are approaching real estate as an investment, then you have to have a long-term horizon. And if you have a long-term horizon, then you want to take the bets that you're taking based on the macro view of things like the asset class or the location and a lot of those things. If you're speculating, it's obviously a near-term profit-making opportunity, and those things present themselves. That's the whole fix and flip market and things like that. But I generally don't like that execution for real estate because it is such a fixed asset that it's super hard to get in and out of a deal, even when the market's doing really well. And so, if you want to speculate on real estate, then you should really be trading REITs in the public market because that's the most liquid avenue by which it could get done. But otherwise, to me, you got to have much more patient, and your investment thesis should be one of, asset appreciation, cash flows, and things like that.
Sure. Yeah, our audience is primarily folks 50 years of age and older, and some of them are approaching retirement, some are already in retirement. They're very interested in real estate investing. Some may be active, may have their own properties. Others, from a more passive standpoint, and maybe involved with syndications, or maybe they're buying deeds or even lending themselves and so forth. But what advice would you have for that audience that's looking for the smart place to be, especially in light of the economy and just the whole COVID hit that we've taken and will probably continue to take here for a while. What advice would you have for them that are looking for an investment that can get a good return on, but not have to necessarily go back to work?
I do think the single family rental space is a great place to be. A situation like that, you're looking for making sure you can preserve your capital, right? And at the same time, you want to create a cash flow where your money's working for you. So, there's really two ways to do that in real estate. Either you're investing and, getting it at a basis, your purchase price, that can sufficiently throw off a cash on cash that, clears whatever hurdle you need it to. With the idea that you are either locking your money in with some fixed rate financing for a long term, and you just know your asset's going to be worth what it's worth. And then the alternative way that I do this with that kind of investor profile that has that threshold, we like to also provide financing directly. So bridge financing. It to me is a great way to really satisfy that because it really checks a lot of boxes. On the one hand, you're putting that money out, you're getting a really attractive yield. Certainly, anything that can beat where you can put that money. Otherwise, again, I'm not talking about investing into an asset directly, but from a private lending standpoint, the way that we always look at deals is what's my last dollar in? And what I mean is if someone is buying a property at 100%, right? Meaning whatever the purchase price is, and I'm lending against that at, say 60 or even 70 or whatever that, LTV is, right? So my last dollar in is in fact 60 to 70% of the buyer's last dollar in. And the reason why I want to look at it from that standpoint is because if something goes wrong with the borrower and their business plan and I end up owning this real estate, am I comfortable at my price, meaning the amount I lent on that real estate to own this deal? And if I have to then go in and collect the rent now directly, am I really happy doing that at, what amounts to 60 or 70% of their price? So, that's always an analysis that we apply. But obviously, you want it all to work well where you're collecting your return and then you can round trip that investment. So, I really like that from capital preservation and cash flow distribution standpoint, but, in terms of asset classes that do that, to me, I think it's really thinking opportunistically, and I always, this is a distressed orientation to this, but, you make your money on the buy. You really have to think about where your buy price is so that you don't have to pay attention to the markets and, where value may go. And you could just really focus in on the fact that the second you buy, you've already effectively locked in your profits. And now you could just focus in on your cash flows and really try to enhance those so that your money is truly working for you and, the real estate is doing what it's intended to do as an asset class.
That's great. Great advice. Do you see any particular areas where you'd say are just a great opportunity, recommend people at this space and time?
I think that if you can buy, whether it be single family, office, industrial, if you can go into a deal that is more value add, in my opinion, I really like that because, again, it really goes back to basis. It goes back to value creation. Now, look, if you're an active investor that can roll up your sleeves and actually create that value, that's great. But obviously, you may have investors that are more passive, and they just want to know that they're going to get, call it a distribution on a quarterly basis of some number, with growth and know that there's preservation there. So in that situation, I would say if you're going to look at value add, do it with somebody who can execute on those. But I mean, look, I really do think that spaces like suburban office, and by extension like medical office, just call it essential type uses are a really interesting place to be. I think the single family rental and build for rent space is just also a growth place to be. It's just also what's great about that space is twofold. One, I think you're just going to have long-term demand by people migrating and wanting to live in homes, and more so. What's really interesting is the industry is so new that financing vehicles that exist today didn't exist a couple of years ago, and so you had private lenders that were operating in the space, and it's because it was so challenging for a lot of the traditional banks who were used to making loans, in the millions and millions of dollars for these big chunky assets like multifamily, suddenly making it on homes. So for the last number of years, and even now, you have these lenders who are mostly private that are filling that vacuum. But I think that as more come into the space and as the space starts to mature, you're going to have much more standardized lending programs. And the reason I bring that part up is because once you do have that, the fact that it's going to be so much more accessible and the financing structures are going to be so much more favorable is going to result in more demand for that real estate. And that's going to translate into more value for the real estate down the road as well, right? Because if I know in the future that I can borrow money simply and easily from numerous sources, then I've already solved for how am I going to pay for this thing when I buy it from you. And there's now going to be, therefore, more buyers having that same resource, and therein is the demand that translates into higher value.
Gotcha. Great point. Well, we're zipping along here. I didn't realize where we were in the time. I hope you're okay at that. Just wanted to find out, for your own company, what excites you for the future of your company, and where do you see it going?
We're coming back to the distress space now. I think we definitely see opportunities, like I said, as the forbearances burn off. And so I'm actively pursuing those kinds of deals, and what I would describe as special situations where, maybe like buyers have fallen out of bed and things like that, where we can jump in and really take advantage of opportunities. But we're really thinking long-term hold. So that those are portfolio building strategies on that end. And we're also building up our lending side of the business, to go along with that, because, if we can't buy, then we could provide rescue capital, then that's okay too. So, that's really part of the business that we've been pushing into, and while I had institutional relationships, in my last fund, since then, all the deals that we've done have been backed by private capital. And it just aligns much better with my view of real estate, because the institutions are typically structured into funds of their own that usually have some kind of end date that it doesn't matter, for example, if you buy a good piece of real estate that you just want to own for a longer term, because it's just good real estate. And you just want to sit back, continue to watch it appreciate, and collect the rents. If you are in a fund and you got to exit by this day, then you just got to sell everything. And that happens all the time. I like being the buyer in those situations, but I hate being forced to sell when it's unnecessary. And so I think the motivations of private investors in this space as a generational wealth creator. And so if you can identify assets like that, and then not have to sell out because, some structure that doesn't necessarily, factor into the real estate analysis, that's just a great place to be. So, that's how we've been also capitalizing our deals in addition to just what we're pursuing.
Yeah, it seemed like, since 2015, 2016, so much of the value add type deals were, where you're sort of your 3-5 year hold max. And do you see that shifting to longer term holds now with those types of deals, or you still think the 3 to 5 works?
I think 3 to 5 can work with value add, but that is to me, for real estate, and if you're buying a fully priced asset, that's a tight deal, because you really got to be good at what you do, or investing with someone who can execute on that value add program, and the market has to align with that execution.
Exactly.
So, at 3 to 5 years seems like a good amount of time to realize a return. And I think certainly it can be, but you just really got to look closely at, how much the dial is going to move in these projections to understand that. But listen, I think it's doable. And I think the financing certainly supports it because those structures exist. So, the way we like to look at it is, at the 3 to 5 year mark, we definitely like to look at it from the perspective of, okay, can we create enough value here that this asset's worth a lot more than what we paid for it? And if that's the case, that then opens up the door to either sell or refinance so that we can actually extract some of our initial investment through that value creation and still continue to enjoy the benefits of owning this asset because maybe there's more runway on the appreciation or rent growth. So it at least, gives us two paths to execute on taking advantage of the value. So that we like to do it that way.
Great. Well, we're kind of running down here on our time, and we have this session we call it a wrap it up session, where I ask you a series of sort of lightning round type questions, and you respond, and people can tap into the resources that you found valuable for yourself. So, if you are ready, we can go ahead and wrap it up.
All right, I'm ready to play.
All right, favorite real estate book.
Am I Being Too Subtle by Sam Zell.
I love that book.
Such a great book. And I would recommend the
audio version. Book. Yeah.
Yes. He's narrating it, and you really just you get the, I think his tone is just, it adds to the storytelling by him of his story is fantastic. So,
I love that book. Yeah. And it's got to be the Audible version. It's just it's just not the same. Yeah. I love it. How about favorite business book? Just general business book.
Yeah. I really like, it's called The Most Important Thing by Howard Marks, who is the CEO of Oak Tree Capital Management, which is a big private equity fund. They actually got acquired by, I believe it's Brookfield recently. But he writes a series of letters on just investing. They're short, and he put them into a book, and it's just really smart, sensible ways to think about real estate from a guy who is running a massive successful organization, and he's done a lot in the distressed space in particular, but he just really touches on fundamental investing in just such a clear and simple way. So I highly recommend it.
Good book. Yeah. How about most valuable website for success?
This one's tough. Website. I don't know. I'm going to cop out and just say LinkedIn.
Boy, oh boy. Yeah, no, I mean, it's true. If you know how to work LinkedIn, it can be amazing. I know people that just live on LinkedIn and their businesses have thrived from it. So, yeah, I mean, there's something to be said for that. How about favorite app?
I would probably go with Overdrive, which is essentially a library book portal that connects you to any libraries with which you have your library card. I think that it was my lifesaver through lockdown because I'm a voracious reader, and I was able to essentially access so many books, and I continue to do it. Audio, ebook, just downloads right to the Kindle. It's just great when you're listening to podcasts or reading something and someone recommends a book and you're like, oh, I want that. It's just like, I just put it on my list, and if it's not available, you can just put it on hold and it downloads for you when it comes in.
That is very good. I've never heard of that one. Overdrive. Did you say Overdrive?
Yeah.
That is great. I've never heard of that one. That sounds like a great app. How about a favorite quote?
The market can stay irrational longer than you can stay solvent.
That's good.
So it is, I really think about that, especially when you're in the distress space, and I go back to this idea of, when I was just like out there talking about how this market is so overpriced, it's just really, I think it's a good check on, thinking about your time horizon, so going back to what you're saying about like, what's the right hold. I think every person's different, right? In the end, you have things that drive your investment decisions. And so, you really want to think about not only, taking the right real estate investment bets, but, what that time horizon is, because this is just, it's a fantastic asset. It's just a wealth builder. I think it just inherently teaches you about business and law and, but at the same time, you really also want to think about, if you have an exit in mind, you want to factor in to whether the market is going to align with when you're looking to either get in or get out. Because, exactly that quote, right? The market could just, be irrational longer than you can stay solvent. So, I think about it a lot, it informs on decisions I make for sure.
Great quote. And final question here. If, for example, you lost all your assets, everything, and knowing what you know, but you only have $1,000 in cash, what would you do with that $1,000 to relaunch your real estate business?
So I think if I had $1,000 to relaunch my real estate business, yeah, that's not a lot. You really, the good thing about this asset class, leverage, right? You gotta leverage that $1,000. So what's the best way to do that? I have to say that, with something like that, I would just be using that money to try to reach as many investors as I possibly could to build up an exponential war chest to be able to buy assets. So, I think rather than the direct investment, which isn't necessarily going to take me too far, I think the money would be far better spent trying to reach people with means to get behind my platform.
Yeah, coffee and lunches, right?
That's it.
Or get a new suit so you can get a receptionist job, right?
That's it. Exactly. I don't know that I would even need to spend that on it, but yeah, that's exactly it. I would invest that into, the best way to market. I mean, it can only be marketing dollars. When you're trying to deal, in the millions, which is what this asset class, is, on the larger end of the scale, of course,
right.
You're buying access and marketing with that $1,000.
That's exactly it. Yeah, that's perfect. Well, I'm sure there's a lot of folks listening that would love to find out more about you, what you do, your company. What's the best way for people to find out about that kind of stuff and maybe even send out a note to you or something?
Yeah, well, so I mean, my company is Capstack Partners, and we have a website, capstackpartners.com. But going back to, LinkedIn, I am on LinkedIn, David Blatt, Capstack Partners, and I am active. So, if you want to reach me there, I am pretty responsive.
It's awesome. Wow. Well, this has been a blast having you on. A lot of great information, a lot of insight, things that I didn't even think about that I think were just very insightful. So I appreciate you for sharing. But it's not over. We have a tradition here on our show, and all of our guests, we're called the Old Dogs, so our guests get to close us out with their best old hound dog howl. So, David, it's all yours. You can just go ahead and howl to your heart's content here.
All right.
All right.
Is that a hound dog howl? I'm a city boy.
I know. It's kind of a New York hound dog howl,
Exactly. It's more like a cat call hound dog howl.
That's true. Well, thanks so much for being on, David. Really, really appreciate it.
Thank you so much for having me. I had a great time.
Yeah, me too. And I also want to thank all our Old Dog listeners out there for joining us. I know there's a lot of other things you could be doing right now, but the fact that you've taken the time to join us means a lot, and we greatly appreciate it. Please note everything that David talked about today will be outlined in detail in our show notes section of our Old Dogs website at olddogsreinetwork.com/blog. Well, that's the show for today. Remember, cash flow is king and real estate investing the means. Until next time, keep moving forward and may God bless.
Thank you very much for visiting the Old Dogs REI Network. We would greatly appreciate if you would stop by iTunes and let us know what you think of the show. We would love if you could subscribe to the podcast, give us a 5-star rating, and write a review. The more ratings and reviews we receive, the more visible the podcast will be to others. Thank you.